am Chethana Jayasinghe. Today I am going to teach you how to preparing a balance sheet or the financial position statement. Actually, this is for the beginners who are learning accounting. So, first of all, let's see what is the main objective of preparing the financial position statement, or the simply, if we can tell, it's a balance sheet. Okay, the prime objective of the preparing balance sheet is to check whether the business agrees the accounting equation. We all are know our main accounting equation is assets equal capital plus liabilities. So after that we are preparing a financial position statement or the balance sheet. We are checking our company assets are equal to capital plus liabilities. So, what are the informations in the balance sheet? There are three main types of informations that are included in a balance sheet. They are assets, capital and liabilities. So, assets we can categorize into two main parts by considering their nature of the asset. First one is non-current asset. It's mean the assets that we are purchasing to use more than 1 year. We are keeping it more than 1 year, and that assets called non-current assets. As well as there is another type of assets, that assets name as current assets. The assets that we are purchasing to consume less than 1 year. Like example, we can say stocks or debtors. Those are the examples for the current assets. As well as the capital. In here, we are trying to identify how owner's equity become changing. The opening capital and the if the owner of the or the relevant party of owner is sometimes doing drawings. So in here we are recording the drawings also. After that we are calculating the closing capital balance. As well as the liabilities, we are considering about the liabilities. Like assets, the liabilities also we can categorize into two main parts. They are current liabilities as well as the non-current liabilities. Current liabilities mean the liabilities that we can settle less than 1 year. Within a less than 1 year, we can settle those liabilities. Example, we can get accrued expenses, the creditors. Those are the examples for the current liabilities. When we go into the other part, the non-current liabilities mean the liabilities we have to settle within not within a 1 year. It takes more than 1 year. We have to pay it within more than 1 year. Those liabilities we can identify as non-current liabilities. We can take example as a bank loan. Bank loan is a very common example for the non-current liabilities. Okay. Here I am going to show the structure of the balance sheet. First of all, we are writing the name of the company because there is a specific concept called business entity concept. It's mean in that concept we are identifying business has a separate entity from its owner. It's mean owner is another party and a business is another party. We are identifying there are two parties. The owner only own the business, but in accounting when we are recording the transactions in our accounts, we are identified those parties are like both two parties. That's why we are mentioning the name of the company above our financial statements. After that, we are writing the name of the financial statement. In here, we are preparing the balance sheet. So, we are writing as the balance sheet at the date, the end of the date only, or the end of the financial date only we are going to prepare in the financial statement, like financial position statement. In here we are identify the balance sheet or the financial position statement now. So we are going to prepare it end of the financial year. So as well as we are putting the our dollars mark or rupees mark, the money measurement. The what is the measurement that we are going to use to value these amounts? Okay, first of all, in the structure, we are going to record the non-current assets. I told you that non-current assets mean the assets that we are purchasing to consume more than 1 year. In here, we can record land, motor vehicles, equipments, and investments. Those are the non-current assets. After that, we are recording the current assets. What are the current assets that we know? We know the cash, bank, stocks, debtors. No, those all current assets, we are going to record it under the current assets. After that, we are going to record the capital. This is the opening balance of the capital. And after that, we are adding the profit and loss for the year. Before that, we are preparing a balance sheet, and before that, we are prepared income statement, no, or the profit and loss account, no. From the profit and loss account, we are taking the net profit amount, and here we are going to record the net profit amount. After that, if the owner doing some drawings, we can deduct it. After that only we can take the final balance for the capital. After that, we are going to record the long-term liabilities or the non-current liabilities. I told you non-current liabilities mean the liabilities that are taken more than 1 year to settle. No, like a bank loan. Like example, we can take as a bank loan. In here, we are recording the long-term liabilities. And after that, finally, we are going to record the current liabilities. What are the current liabilities that I told you? I told you that accrued expenses and the creditors. No, those are the current liabilities, and we are going to record in here. After that, according to our financial equation, assets equal to capital plus liabilities. By using that accounting equation, we can balance this balance sheet or the financial position state. Do you think, as our wish, can we record the entries in the balance sheet or the financial position? The answer is no. There is a specific basis behind that. That basis or the theory called we can identify as liquidity basis. Liquidity basis. What's the meaning of liquidity basis then? Liquidity basis means some entry or an asset or a liability, the time that we are going to transfer to a cash. That's called liquidity basis. Like example, stocks and the debtors. Stocks and the cash. We'll take stock and the cash. Tell me, think yourself. Uh, Stock and the cash. What is the highest liquidity one? Cash or the stock? How are we going to think about that? For a stock, if we have a stock, think we have an external additional stock, and we want to give it to another person, or we want to sell it to another person. What are the things that should satisfy, or the essentials that should be satisfied? The person should have a capacity to purchase those stocks, as well as the person who is going to purchase our stock should be a willingness, no, the desire to purchase those stocks. And the person should have a need to purchase that stocks. Uh, those things should be essential, no? After that only the persons agree to purchase our stocks. After that only we can earn in some money. It's mean it takes little bit long processes, no? But comparatively the cash. Think you have a 5,000 rupees, a note, cash note. You can easily go into a shop and convert into 100 cash notes, no? You can easily convert by comparatively to the stocks, no? That's why we called cash has a 100% out of 100 the liquidity. So the liquidity is high mean we are going to record it in the under each of the category in under. In here stocks we are going to record in first, and after that only we are recording the cash because the liquidity is 100 out of 100, no? The cash. Okay. In here I'm taking example. Following are the details of Frank Woods Private Limited as at 31st of December 2025. Here they given some details: debtors, creditors, bank loan, land and building, machinery, motor van, and the net profit. After they prepare in the profit and loss account, and they given the net profit. They calculated the net profit and given us. Okay. For the additional information, they are given as closing stock. Okay. Shall we record in those details in a balance sheet? I told you first of all, we should write down the name of the company. In here, I mentioned the name of the company. What is the name of that company? Frank Woods Private Limited. So first of all, we should write down the name of the company. After that, we should write down the date that we are going to record the balance sheet, the end of the date of the financial year, 31st of December 2018. Okay, after that, we are preparing the structure. First of all, I told you, first we record the non-current assets, then current assets, capital, long-term liabilities, and the current liabilities. Okay. We'll see what are the details that they given. First of all, they given debtors. Debtors mean, first of all, we should identify it's an asset or a liability. Debtor mean asset, no? Then we are going to record it under the current assets. So, keep a space and write down debtors, 7,800. Then, creditors. Creditor is a liability. Which liability? Current liability or non-current liability? It's a current liability, no? Then going to the current liability and we'll record the creditors. In here, we are going to record the creditors. Then bank loan. I told you bank loan is a non-current liability, no? Then under the non-current liability, we can record it as bank loan. Here, like this. And land and building. Land and building is a asset. Which type of asset? It's a non-current asset. So under the non-current assets, we can write down land and building. Land and building. Next one is machinery. Machinery also a non-current liability. We are taking a machine or we are purchasing a machine to use more than 1 year. So it's fall under to non-current assets. Under the non-current assets, write down machinery. And motor van. Motor van also non-current assets. Write down under the non-current assets, motor van. then they are already calculated the net profit, no? Then we can have only to record it. Net profit. Net profit is we should record under the capital. Write down under the capital net profit. So they given the closing stock. They already record that the closing stock in the P&L, but in here they didn't record it in the balance sheet. They asked to prepare in the balance sheet, no. So we have to record the closing stock under the current assets. We already leave a line because of that the liquidity basis. First of all, we should write down the stocks. After that only we should record the debtors. So in front of the closing stock, write down the amount. 78,000. Okay. Now we are already recorded all the transactions that they given. Now we have to balance. What is the that rule? Assets should be equal to capital plus liabilities, no. Then first of all we'll get the total amount of assets, both current and the non-current assets. This is the total amount of non-current assets, 495,000. In here the current assets amount 85,800. This is the total amount of assets. After that, we should take the total amount of capital and liabilities. Capital under there is only a net profit, so we can put that amount in the our second column also, as well as the long-term liabilities. There is only one transaction, so we can record it on under the second line also. As well as the current liabilities also, there is a one transaction, so we can record it as the second column. So we can get the total amount in here. If you can see my screen properly, the total assets are equal to capital plus liability. This is how we are going to prepare a balance sheet. Okay. Thank you. I think you can understand how to preparing balance sheet and what is the rules that we are going to include or the consider when we are going to prepare a balance sheet. Okay. Thank you. Bye.